afternoon, everyone. Thank you for being present here today. Before we start the presentation, let's introduce the team members. I'm Emami Ltd,
Rajat Sethia,
Ramya Ramaswamy,
Deep Mehta,
Sandeep Agrawal. Let's start with company's brief introduction. Emami is a niche player in personal care industry in India. It has a strong focus on Ayurveda and its power brands include Navratna, Fair and Handsome, Jhandu and Mentho Plus and Boro Plus. Promoters are the major shareholders in the company and own about 73% of shares. Company recently published its Q2 2012 results. Numbers were lower than the analyst estimates, but underlying trends were positive. Company achieved a revenue of 3.1 billion rupees with a growth of 16% from the corresponding quarter last year. In spite of economic slowdown, the company was able to achieve such a high growth because of its focus on international business. Its overseas revenue grew by 30% during the quarter from the corresponding quarter last year. Though high raw material prices put the pressure on the margins, but improvement in efficiency helped in easing this pressure. Early arrival of the monsoon also impacted the sales of its summer products. The company incurred forex losses of 66 million rupees due to mark-to-market provision towards the US dollar denominated loan of 2 billion rupees. Without the forex losses, the company's net profit would have grown to 10% from the corresponding quarter last year. Based on our fundamental analysis, we see Emami invigorated by innovative branding and recommend a buy rating with a target price of 483 rupees, having an upside potential of close to 21% from the current market price. Now I would request Deep to take over.
Thank you, Sandeep. Let's start with the investment rationale. It begins with brand investments. Having positioned itself as making people healthy and beautiful naturally, Emami has created a strong brand equity through its power brands and effective advertising across diverse media. The ad spend to sales ratio of 18% is highest amongst its peers versus industry average of just 12%. Roping in high-profile celebrities across different regions to endorse its products, Emami has increased awareness, resulting in high brand recall. As a result of which, many of its products are industry leaders and way ahead of its competitors. The year-on-year growth rate and market share look extremely impressive, and we expect it to continue going ahead, resulting in high equity. As for the financials, the year-on-year growth rate for the revenue has been highest for the past 3 years, and PAT has been highest for the past 2 years. Almost 80% of its production comes from text-exempt zones, resulting in superior EBITDA margins. Yes. As a result of which, it is able to launch new products. A combination of good cash and low debt to equity ratio, coupled with new product launches, will surely give Emami enough funds to fund its future inorganic or organic growth opportunities. Aggressive growth. Apart from good organic growth, the inorganic growth was triggered by the Zandu acquisition and the intent of management to make more such acquisitions. With no single product contributing more than 18% of its revenue portfolio, it's a well-diversified portfolio indeed, with a combination of cash cows and stars to fund any new product launches. Some of the products have grown by more than 100% since launch. We expect at least 2 to 3 products each year. Being present in the niche sector, having low penetration and very high growth, along with its focus on Ayurveda, we expect Emami to give the customers the natural products they want. Apart from that, its focus on Ayurveda and the increasing consciousness about the use of chemicals, Emami is best positioned to leverage this opportunity. I request Ramya to continue with the investment rationale.
raw material management through constant hedging policies and single vendor sourcing strategy, along with strong relationship with their key vendors, are some of the value drivers for Emami. The company has constantly introduced innovations in packaging, which have resulted in significant cost reductions. The company has also undertaken various operational initiatives to improve the overall efficiency. Emami is known for its highly skilled R&D team, which works in sync with the Zandu Foundation and the Himani Ayurvedic and Scientific Foundation to constantly dole out innovations, not just across existing product categories, but also create new categories, like in the case of Emami Fair and Handsome. The company's launches over the past decade have been highly successful and contribute to an increasing percentage of the revenues, and we expect this to continue. Distribution plays a key role for any consumer goods company. Emami, after the acquisition of Zandu, has a total retail reach of 3.1 million outlets, and these are well diversified across all the states in the country. The company has also undertaken Project Swadesh with the aim to cater to the rural markets, with the aim to reach out to all 5,000 plus villages by the end of year 2013. Emami is also well diversified across all the regions, and thereby it reduces any region-based risk. On a global level, Emami is present in more than 65 countries worldwide and has proposed manufacturing units in Egypt and Bangladesh to cater to the growing demands in these regions. Emami's strong corporate governance standards, along with compliance to the mandatory clause 49, and also its well-focused management, makes Emami a professionally run family business. With this, we wrap up our investment rationale of innovative branding. I now request Rajat to continue.
Let's look at the financial highlights now. We expect net sales to grow at a CAGR of 21% over financial year 2011 and 14. The sales growth will come from both domestic as well as overseas market. As for margins, we expect a 80 BPS increase in EBITDA margins, primarily driven by reduction in raw material prices and declining advertising spends of the company. Down to the bottom line, we expect 22% CAGR in EPS over the next 3 years. The lesser growth in EPS as compared to the past will be mainly due to the increased tax rates. The company has strong free cash flows due to its little reinvestment needs. The strong free cash flows will be used to repay debt. The company is expected to have a healthy balance sheet with zero debt and a strong cash position, which enables company to pursue any organic or inorganic growth opportunity. Moving on to Emami's valuation, we've employed a 3-stage DCF model with different sales growth assumption in each stage of the DCF. In the first stage or the analytic stage, we assume a sales growth of 20% in the domestic market and 30% in the overseas market. In the next stage or the convergence stage, we have assumed an exponentially decaying sales growth that connect the last growth of the analytic period to the perpetuity that follows. In the perpetuity, we have assumed a sales growth of 5%. Moving on to the assumptions of our DCF, we expect COGS to subside from the current 40.9% to an average of 39% over the projection period, primarily driven by reduction in raw material prices. There has been a declining trend in the advertising and promotion expenses of the company, and we expect it to further decline to an average of 17% over the projection period due to increased brand maturity and higher turnover of the company. The WACC that we have used to discount our cash flows have been computed differently for the current and the terminal first period, with the main source of difference being the country risk premium, which is expected to subside in the terminal period. The tax rates have been assumed to increase over the subsequent stages of the DCF, with a marginal tax rate in perpetuity. Our DCF target price is 483 rupees, which presents a 21% upside. As compared to its peers, Emami is trading at a lower PE multiple and has better growth and margin. Based on our analysis, we believe that Emami has the greatest upside potential amongst its peers. Moving on to risk, we performed sensitivity analysis using terminal WACC, terminal growth, and COGS by sales. Based on our sensitivity analysis, we have devised 2 additional cases, stress case and the optimistic case. For the stress case, we have taken an average of all the worst case scenarios. The stress case price is 459 rupees, which presents a 15% upside. We also performed Monte Carlo simulation to estimate the combined effect of all the risk on our target price. The result of our simulations show that with an 80% probability, the target price will fall within 445 and 525 rupees. Now I request Anshu to continue with the investment risks.
We now shift our attention to the investment risks that could affect the performance of Emami. These risks have been divided based on their probability of occurrence and the impact they may have on the company. They have been divided into different categories: strategic risk, operational risk, and external risk, depending on the sources from which they originate. The first strategic risk is from succession planning. This comes out from the fact that the founders plan to retire after handing over the business to next generation. Other strategic risk being failed product launch, which may result in lower sales for Emami if the new products do not meet customer needs and taste, and brand risk, which may affect Emami's market position due to growing competition. The first operational risk is from raw material price fluctuations, as 50% of Emami's raw materials is linked to crude, which exposes Emami to price shocks. The next operational risk is quality risk. Emami operates in a highly competitive environment, and any decline in its product quality may impact the brand perception and the profitability. The first external risk is from macroeconomic factors. A tighter monetary policy from RBI may impact customers' earnings and hence the expenditure. In addition, an industry slowdown or downturn may also affect the business sustainability. Poor monsoon and political instability as well as currency fluctuation may impact the revenues coming from domestic, rural as well as international market respectively. A cool summer and a hot winter may also affect the sales growth adversely. The last risk is counterfeit risk. This is the major risk from which the entire FMCG industry suffers. Product imitation may impact the brand perception and lower the profitability of the company. Keeping the mitigation factors as highlighted with good governance and management function, we recommend a buy for Emami invigorated by innovative branding with a target price of Rs 483. That's the end of the presentation. Thank you for your attention. We'll be pleased to take any questions you have.
Ready?
We just speak.
Ready?
Yeah, ready.
Okay, the first question I have is, what is the rationale in your WACC calculation for 5.9% risk-free rate?
So we have used the for the first bond rating, 10-year bond rating, which is 8.3% for India when we were doing the calculation, and we have subtracted a default spread from it, which was around 3.6%. So with that we have 2.4%. We have calculated a default spread from the Damodaran's website, which is based on the Moody's rating, which is BA3 for India. So based on that we have calculated a risk-free rate.
Thank you.
You said international sales will grow at 30%.
Yes, sir.
What is the base you're starting with, and why do you think international sales can grow at 30%?
So for first.
So actually, the base is last year, the same quarter two, quarter two, and we see because.
What is the absolute number, if you could suggest that to me?
It's around. It's 14%
of the total revenues, and the total revenues were 1277 crores. So it was around 200 crore the exports, and the last 5 years growth has been 35%, and they are rapidly expanding into the international markets. So we see that this growth will further continue, and we have in the next stage of our DCF we have assumed that it to exponentially decay to 5%. So for the first 3 years only we have assumed a 30% growth.
And sir, over the past, the company's performance in the international market has been around 30% growth, and the company also proposed new manufacturing facilities in Egypt and Bangladesh. The Bangladesh facility will start in March 2030, and this is because there is a lot of demand, not just from Indians settled there, but also from the actual population, and a lot of Emami's products, including BoroPlus and Fair and Handsome, are the market leaders.
Which countries do they export to?
So basically MEA and Russia, where BoroPlus is the market leader, Singapore and Bangladesh, and little in UK.
So we had also done a Google trend analysis to see the countries, if any people in different countries do look up to these products. So using that Google trend analysis, we did find out that the demand for these products was very high in Middle East as well as Africa, showing that people do look up to these products and want to know more about those products. So as a result of which we say that adding on to the demand, these products have good brand awareness amongst the people out there.
You compared the valuations of Emami with some of the Indian peers, and obviously it makes sense to compare it. But in your profit growth slide, the profit growth numbers for Emami were the most volatile. So for someone which has such volatile earnings growth trajectory, whether it is negative or positive, would you still warrant a valuation which is similar to a more consistent peer group?
So one of the reasons why this has been so volatile was that they acquired Jhandu, and also the other reason was that they demerged the Emami Realty from the company. But now they are focusing on the FMCG business wholly, and we expect that the profit won't be volatile as it was before. And if you look at the past 5 years growth in the profit, it has been 45%, which is more than any of its peers. Yeah. And the company is currently trading at a much lower PE multiple than its growth and margins would warrant. So that's why we have said that it has a better upside potential than its peers.
Also, sir, the losses which were in the current quarter were mainly due to mark-to-market losses on forex loans. So, and we expect that to come down, and subsequently it will be a zero debt company going ahead and with sufficient cash on the balance sheet. So that wouldn't impact have a huge impact on the results as it has now.
Sir, one more thing, like other FMCG players didn't do well this quarter also. But Emami suffered more because they didn't cut down the brand advertisement and other distribution channel investment. So in short term, other player can gain by reducing the brand investment and distribution investment. But in long term, that would harm them. So Emami stands out over there.
So one more thing regarding the recently passed Commodities Bill 2011, the ministry has specified around 20 packaged products which cannot change their sizes and have to either do certain standards, packaging standards. And in none of the categories, Emami is present. So that gives them sufficient leeway in changing the pricing on the content at will, and that would impact the other companies a lot. So that is one reason why I would think Emami would benefit from this.
Regarding future sales, I see here that you're expecting 2 to 3 products a year, which seems pretty aggressive. And yet you also are dealing with the exponentially decaying sales growth. So for your forward-looking view, can you tell me how you balance those two opposing trends?
So the 2 to 3 product launches we expect over the next 5 years, and in the next 3 years, the first stage of our DCF, we have taken a sales growth of about 22%, the CAGR sales growth. And see, if we look over the past 3 or 4 years, they have been launching 2 to 3 new products. And when we talk to the management, they said that they would be interested in categories like aging creams and the hair dyes. Yeah. So we believe that this trend will continue. Yes. That's why we took a higher sales growth in the first 5 years. After that, we see that because of the higher base, their sales will decline.
And they have a few products in the pipeline over the next few years. Hence, we can be sure about the projections we have made in our valuation.
Moreover, Emami, the basic reason for Emami standing out and having a higher pricing power is their R&D team, and their R&D team is led by one of the PhD candidates who focuses on Ayurveda. And Emami being the only player that focuses on Ayurveda, they know that Ayurveda and new products are the only way for them to grow, and that is what we expect.
And so with new product launches, we also mean the brand extension that they do. Yeah. So with that, it's easily possible that they can come out with 2 to 3 new products.
Thank you.
From governance point of view, how would you rate the company in the same category as other companies with whom we are comparing the valuations, looking at some of the recent track record of events in the company?
So given corporate governance, adherence to clause 49 is obviously mandatory for all the companies. Apart from that, being a new company, the other non-mandatory requirements they have been following, like training of executive directors, adhering to whistleblower policy, then investor grievance committee which they have formed. Apart from that, they have, although CSR is led initially, but as compared to the size of the company, it's growing every year. So we expect Emami to do well in that sense. Obviously, as compared to other companies, since it's a new beginner, obviously it cannot be compared as such, but then we expect it to improve a lot on its corporate governance.
But they went into real estate 2 years back, right? 3 years back?
Yes.
Using the cash flows from the consumer business?
But sir, they demerged also that business. And sir, if we see the board of directors, their qualification, the independent directors, I think they are one of the best among the mid-cap companies. So that itself speaks volumes about their corporate governance. And sir, after that recent events like we see the Emami hospital event, I think the compliance will only get stricter in the Emami group companies.
Thank you.
What is their payout ratios for dividends?
So payout ratio is about 30% and the dividend yield is about 1%.
Yeah. For example, Lever has a dividend yield of about 3% a few weeks back. So
yes,
shouldn't the PE of Lever be higher because the payout ratios are so much better and the yield, despite being Lever, is higher? So why do you think the PE ratio should be re-rated of Emami?
Sir, PE ratio tells like how much investors see the growth prospect of the company. HUL is already a very mature company. Emami is in the growth phase. So obviously the amount which investor would be willing to put in Emami, it would be, the PE ratio would be higher in case of the Emami, because investor would see that it's a growth company and future it would give the more income than the HUL in other companies.
Yeah, recently also regarding the big players like Unilever, in the recent past they have grown up by around 22%, while rest of the mid-cap FMCG firms like Emami have come down. The reason for that was Unilever cut down on ad spends, also the prices for palm oil reduced by 9%, which was the main component of most of the products. While for Emami, the price of mentha oil increased by around 19%, and they could increase the prices by only 8%. So even in those scenarios, HUL has sufficiently appreciated over the past few months, and Emami has corrected. So that gives more of an attractive opportunity to buy into this company as compared to others.
Do you expect the P ratio of Emami to catch up with Lever, or do you think this is just an earnings growth story?
So
do you think a P ratio should be re-rated of Emami?
Yes.
You think it should be re-rated?
Yes, I think so. The PE ratios of HUL are currently very high. They should come little low, and Emami we think is correctly priced currently.
Okay.
Why don't we talk a little bit about this Monte Carlo simulation? What was driving that again? Were you concerned about some of these risk factors maybe manifesting themselves, or What
So
exactly
the main
was the
reason
goal?
that we did the Monte Carlo simulation was that, like the sensitivity analysis, they would consider only one risk at a time. But this approach has the advantage that it combines the effect of all the risk on our target price.
To all of you. My name is Shubhro and my team members, Abhishek Jain and Abhishek Bohara. Tonight we are going to present our analysis on Coromandel International Limited, which is a subsidiary of the Murugappa Group. And our entire presentation is going to be based on one single word, buy. My team members are going to walk you through the reasons behind our buy recommendation at a target price of rupees 397, which translates to a 36% of upside from the current market price within a time horizon of 18 months. And the points and the reasons behind our buy recommendations would be a high margin, the increased focus of the company towards high margin non-subsidy based business, a strong management and a sound corporate governance, market leadership and the brand recognition together with the cost efficiency and the backward linkages that the company is having. Now in our presentation, our basic objective would be to building upon all these points and establish beyond any reasonable doubt that you should invest in this particular company. Now let us move ahead with the company's overview. The overall business of CIL can broadly be classified into two parts, subsidy and the non-subsidy based business, where the subsidy based business is currently